So welcome everybody to Impactful Insights. My name is David Wolfscale. Always excited when I get to interview Terry Putney, one of the top 100 influential people from accounting today in the CPA marketplace, 12 years in a row. But even more on a personal basis, I do meetings with Terry. He's part of our team. And when I'm in a meeting with Terry and a client, I know Terry's bringing great insights because of that history, because of his experience, and because of him seeing so much. So I'm always very excited to get some content from Terry to share to our CPA audience. So Terry, why don't you do a quick intro and then we'll get to the topic of the day.
Well, thank you, David. I've been doing this consulting work for about 25 years, strictly with CPA firms, and mostly involving involvement with mergers and acquisitions between CPA firms. That's historically how it's been done. And in addition to that, I also do some work in working with other issues around ownership of CPA firms, including helping firms with internal succession planning, working on their owner agreement. Often many firms have outdated owner agreements that really aren't working in today's market. How to admit new partners into your firm, which some of the tried and true things that firms have done in the past don't work anymore, and how to buy out retiring partners. So, but for the most part, again, probably 80-85% of my work is involved with mergers and acquisitions. Happy to talk today about what we're going to discuss here, David.
Well, and again, if you have Terry on your team, if you're doing the merger, you are lucky with the depth of knowledge. So Terry, for a long time, valuations were really the same, right? And for a long time, they were kind of stagnant. The mindset was very similar, but in these last couple of years, we've had some new players enter the marketplace. And of course, the traditional players always adapt to that as well. So why don't you share what's going on with valuations in CPA firms? Because if you're an owner, this has a huge and I think positive impact on your future. So Terry, why don't you share?
Well, over the years, David, I've probably presented on valuation of CPA firms in webinars and in conferences, other speaking type engagements, dozens and dozens of times. And one of the things that I always was included in my talks was, what's the multiple? Because that was the biggest question we always got from both firms interested in selling their firm and firms interested in buying other CPA firms. What's the current multiple? And of course, the answer was always, well, it depends, but we always expected that to be somewhere in the range of, say, 80% to 125% of revenues. And that's about as far as the analysis ever went. And of course, those that felt like they were worth a premium expected more than 1x, and those that kind of were more interested in getting something just done were willing to accept something less than 1x, but 1x was kind of the rule of thumb.
Well,
for a long time. And so, as it turns out that, the firms that had a little more of a nuance in the way they were approaching this might look at it and say, well, it's really not a multiple of revenues, it's a multiple of owners' compensation. And so, if we're valuing our firm internally at 3 times owners' compensation in our retirement plan, maybe we should be buying firms at 3 times compensation. But then you'd get a firm that was generating a 40 or 50% profit margin, and they'd say, well, yeah, maybe it's 3 times comp, but it's really not 1.5 times revenues. Maybe we ought to scale that back some. So we always tended to get back to that 1x type revenue. Well, now coming into the marketplace comes the private equity firms. And the only reason why they ever talk about a multiple of revenues is because they know that the accounting firms they're talking to still think that way, but they don't think that way at all. It's always about, a multiple of profitability. And the profitability, of course, requires a lot of analysis, but generally we're talking about, a negotiation between the private equity buyer and the firm that's selling on how much compensation should be considered profit and how much should actually be considered compensation. So we're in a whole different level, a whole different area of how to value CPA firms. And we're actually seeing that firms that are not private equity firms that have, that want to compete with private equity firms in terms of mergers and acquisitions. And I'll point out that most large firms expect as much as 2/3, if not 3/4 of their growth to come from mergers and acquisitions. And so it's a very important part of their strategy to be competitive with mergers and acquisitions. But we're seeing them, starting to behave like private equity firms. And, it's a whole different area now of how to value a CPA firm. David?
And so when we look at valuations, what are some of those key components that the PE, and I think it's much more than PE, right? It's PE, it's family office, it's publicly held company. There's a whole platform of these alternatives, but what are some of those key things that they look for when they're doing the valuation?
Well, let's just take a sort of an average situation. And let's say an accounting firm has about a 40% profit margin, which means, and again, in the way firms traditionally look at themselves, 40% profit margin means what's the profit before we pay any of the owners any compensation or any benefits, net income before any compensation and benefits. And 40% is, it's above average, but it's not significantly above average. So let's just use that because it's a round number, and we see a lot of firms at about that level. And let's just decide that we are going to consider half of that compensation or half of that profit compensation, and half is going to be the profit. And for most firms in the country, most of these PE firms are somewhere in the 6 to 8 range in terms of what they're willing to pay times the amount of profit that's considered real profit, or EBITDA in their terminology. So a 40% margin with if we consider 20% of that profit, times 6 is 1.2. Well, 40% times 3 is 1.2. So we're really not that much different than we ever were before, but this gives us the ability to actually, evaluate what the true profitability of a firm is and distinguish between a firm that's at 40 and a firm that's at 30 and a firm that's at 50. And another thing to take into account here is, sometimes the profitability of a firm is kind of, in a way, unsustainable. So let's take a really extreme example. You're a sole proprietor, and we've all seen these kind of practices, and maybe yours is this kind of practice. And you have very few employees. You do almost all the work yourself, and I've seen that happen in lots of firms that are in the $400,000, $500,000, $600,000 range, where the vast majority of that revenue is from the owner. Well, that profitability is not sustainable, obviously, in a larger operation, because someone else is going to have to do that work, and they're going to cost something. So there are situations where we can't get crazy with the way we look at this profitability. We have to really, drill down to see if it's sustainable. But, this is what's changed, is that, forget about what your revenues are and what the multiple of revenue is. You really need to look at the profitability and understand how your firm or a firm you're wanting to acquire, what that really means in terms of valuation, the connection between profit and value.
And so let's also talk briefly about something else that's changed, right? I think the importance of geography has also changed, where it used to be that people were looking for strategic areas, we're looking for big areas. Why don't you talk a little bit about how geography has also changed as these new players have entered the marketplace?
Well, it really depends on the player, of course. So some players still use the same, strategic targets for geography that they've always used, even if they're private equity backed. So, many firms are saying, look, I don't really need an office in a market that might be 300,000 or 400,000 people. And so they're still not interested in those kind of, mergers or acquisitions, even if they're private equity backed. But there are some some strategic buyers, whether they're private equity or one of these other buyers, that look at it and say, you know what, geography doesn't mean anything to us anymore. What we're more interested in is, the quality of the practice, the profitability of the practice. It's not like they're going to, maybe enter a market that only has 25 or 50,000 people in it, but we're seeing a lot more loosening of the standards now, where markets that in the past were of no interest at all to the large firms, national firms, are all of a sudden of interest to some of these strategic buyers. And, we've seen firms tell us that, their threshold is as low as 350,000 people. And so, it really depends on the buyer, but the important thing to understand is you got to find the right buyer that's interested in your marketplace.
And then one other thing also, when these new players entered the marketplace, we heard about Citron Cooperman, we heard about Eisner Amper, and there's not that many firms that size. So also, why don't you just share some insights into these new strategics? Is it only for the big players, for the $500 million plus firms, or is it really for any size player? So why don't you share some insights there as well?
Well, the market does break down into segments. And so you mentioned one of the segments, which is the top end in terms of size. And there's right now 3 of those. You didn't mention Cherry Beckert or the other one.
Excuse me.
And there's probably going to be 1 or 2 more that will soon enter that sphere of size. There's also, and again, I want to point out that there are some firms of similar size to those that are not private equity backed that claim that they can do deals that look just like private equity deals. They've amassed enough capital that internally that they can actually compete with private equity in the way they do their deals. So that's still that segment. And of course, those firms tend to be a little more strategic in the way they look at their acquisitions. They are really targeting, certain service niches, there's certain geographies, certain industry niches. And so they're a little more selective in what they'll look at, just like they always were. And then the next category down are the firms that are actually probably more in the realm of roll-up. And what they're really trying to do is amass volume. So it's okay for them to acquire firms that are in the, $5 to $30, $40 million range that don't necessarily have a specific strategic fit, other than they are willing to be part of a group that they're trying to assemble. And what they're trying to do, in essence, is build, a $200 to $500 million accounting firm through these acquisitions of these size firms. And generally what they're looking for after they do what they call a platform acquisition is they're looking for, tuck-ins, which are firms that are generally geographically close to where the platform firm is, that are smaller and can be merged into that firm to help grow that particular platform. And then you've got firms that are actually, without regard to the platform concept, are really just trying to do it no matter where it is. And so, they are very flexible in terms of geography, very flexible in terms of size. And again, their goal is to amass a $200 to $500 million firm, but they're willing to do it in a very flexible manner. And the important thing there as well between those 2 segments is, and Cherry Beckert and Eisner and Citron are all good opportunities for many firms. I'm not trying to denigrate any of them, but you're going to become part of that firm. And what happens in this more roll-up type operations is that you're probably going to retain your identity, if not permanently, at least for a long time. And so it's a completely different post-merger experience. There's advantages and disadvantages to both.
And so I think one of the key points is for a leader of a firm, a lot more flexibility as far as valuations, as far as geography goes, and as far as options. Do I want to go into a bigger firm? Do I want to keep my identity and take some chips off the table? And that flexibility also brings complexity. So I think having somebody like Terry on your team, having somebody like Whitman Transition Advisors on your team certainly helps you accomplish those goals. So Terry, I appreciate your insights as always, and feel very lucky to be that you're part of our team. Why don't you share a little bit about some of the services and do a little commercial for yourself and the WTA team?
Well, one of the things that is specific to what we've just been talking about is a top line valuation summary of your firm. So what we can do in the course of just gathering a little bit of financial information, having a conversation with you that can be as short as an hour, we can give you some insights into how your firm fits into this new marketplace. What are your strengths and weaknesses? What kind of firms would be a good fit for you? If you're interested, what your value might be. And you can do nothing with that more than just say, oh, that's interesting. If I ever become interested in doing something, now I know more. Or we can actually turn that into helping you, actually execute a plan to take advantage of what you learned from that. But, it doesn't have to be, and it's no cost. Happy to spend the time, within reason. Again, we're talking about usually about an hour with some financial information gathered in advance, and talk about what those options are for you, and use that as a learning tool for how to manage the future of your firm.
And one of the things I see when I talk to managing partners is a lot of them are having conversations among their partner group whose information is based on a random phone call or perhaps a random meeting instead of somebody who knows the marketplace and probably done 10, 15 deals this year, and we'll probably do at least that many next year. So Terry, always a pleasure to have you share information with our team. And for our audience, I appreciate you spending a couple of minutes with us, and I hope you got some insights. We're here to help. We're here to have an impact. Go crush your day. Terry, thank you very much.